Hi, everybody. This is Tuesday, May 19th, 2009. First up, we got some economic data that came out this morning on housing starts. And according to the news, they unexpectedly declined. Now, how can people not expect housing starts to decline? We have a glut of unsold homes. There are millions of homes sitting vacant. We can't even sell the homes that we already built. Why should it surprise people that fewer homes are being started? In fact, what surprises me is that any houses are being constructed at all. In fact, the fact that builders are still building properties, despite the fact that they can't even sell the ones that have already been built, shows to me that home prices are still too high, that the government is still subsidizing new home construction. They're subsidizing mortgage rates. What we should do is let home prices fall. And if they fall enough, then people won't build any more homes. It makes no sense to construct new homes when we want to sell the homes that are already there. Why don't we use those resources more efficiently? Instead of building more homes into a market that's already saturated, why don't we free up that labor and those resources, that capital, to doing something that we actually need? Now, unfortunately, I think what's going to ultimately happen to put an end to new home construction is the government is creating so much inflation to prop up home prices that eventually building new homes is going to be so expensive because of the material costs that it's not going to make any sense to do it. And then it's going to grind to a halt because it'll be much cheaper to build and to buy an existing home than to build one from scratch. So that'll put an end to it. But in the meantime, we're adding more supply on a saturated market. And by artificially interfering with the market's attempt to bring down home prices, the government is actually increasing the glut and ultimately making the home price problem worse, because now we have a bigger supply out there, and so real prices have to fall that much further. Also, talking about the stupid things that governments do, today the Senate now passed its version of this credit card bill, which has been championed by Chris Dodd here in Connecticut. But I mean, here's an example where the government might actually do some good, but it's the opposite of what they want. And I don't approve of the means. I like the ends, but I don't like the means. What they're trying to do, presumably, is help people who rely on credit cards, to help protect them from these greedy credit card companies that are unfairly charging them excessive interest and excessive fees. And so they're trying to help out credit card borrowers with this bill. But like most government regulations, the result will be the exact opposite of what their intention is. What this bill will do, by making it riskier to be in the credit card business, by making it more difficult for credit card lenders to accurately price risk, they are going to increase the risk and cost associated of lending on credit cards, which means credit card companies will have to respond by tightening up lending standards, by lowering limits, by issuing fewer cards. All of this ultimately, I think, is a good thing, but it's the opposite of what Congress wants. Now, what I'm afraid of is that when the credit card companies respond to this new regulation by trying to limit their risks and issue fewer cards and have higher introductory rates, or eliminate those teaser rates and have tighter standards, the government might interfere. The government might tell the banks, look, you guys are getting TARP money. We want you to keep making these credit card loans. And even if they result in bigger losses for the bank, don't worry, the government will come, we'll give you more money to make up those losses. And that would be something that happened like the housing market, where the government passes a law and then they encourage the banks to make foolish loans anyway. And then when they have losses, they subsidize those losses and bail them out. That's something that I'm afraid is ultimately going to happen as a result of this bad bill. But again, as I said, I think we want less credit card lending. And I think there would be less credit card lending if the government simply stopped bailing out banks and stopped bailing out lending institutions. It would be more difficult. And of course, Congress is pretending they want to protect consumers from having to pay these outrageous interest rates. I agree, they are outrageous. What consumers ought to do is stop using their credit cards. Don't borrow money to consume, and then you won't have to pay any interest. That's a much better way to go than borrowing all this money and trying to hope Congress will pass some kind of bill limiting the rates. Anyway, I want to move back into the markets and talk about what's going on. look at what's happening with the dollar. The dollar index today closed right at 82. We actually traded below 82 briefly towards the end of the day. This is the lowest close for the dollar index since October of last year, October of 2008. And ever since I pointed this out on this podcast or on this blog, we had a reversal about a month ago on the weekly charts. And at that time, the dollar index was at 87. It's now dropped from 87 to 82. And the chart looks very weak right now. There's a rising wedge that looks like it's about to break to the downside. My near-term price target for the dollar index would be around 80. And I think we could get down to that level within the next 2 or 3 weeks. Once we really break below 80, there's really no support for the dollar index all the way down to its record lows in the low 70s. And I think we can certainly be at that level before the end of the summer. And then, of course, if we take out those lows, as I fully expect it to do, this dollar decline should turn into a rout, and we get a run on the dollar. And I think also, if you look at what's happening to the gold stocks, this seems to bear this forecast out. Gold stocks were very strong again today. In fact, the Philadelphia, the Huey index, the Gold Bugs index, traded at its highest price since August of 2008. August. Basically, since the last time the Huey closed at this level, we had better than a 50% decline in gold stocks. 100% of that 50% decline has now been made up by the recent rally. Now, we haven't got all the way back to the highs of 2008, but you know what? It's not that far a climb from here. I wouldn't be surprised to see new highs in gold stocks before the end of the year. That would mean 100% of the paper losses that people suffered in gold stocks in 2008 who bought it at the highs will have been reversed completely in less than a year. And of course, people like myself, I was fully invested in gold stocks back then. And when we had that 70% plunge, rather than worrying about the fact that my gold stocks had gone down so much and second guessing my long-term strategy, I took advantage of that dip. I bought more, and I am very well positioned right now as a result of having added to my gold positions in that decline. Meanwhile, there are a lot of other people out there who were second guessing the inflation scenario, second guessing gold, talking about how this decoupling theory was nonsense. I think what we're seeing right now, and again, I mentioned it yesterday, the strength in the emerging markets, what's going on in India, I think it shows that that forecast of decoupling is exactly what we're having. And it is very ironic that, we had this head fake to get everybody to jump to the wrong conclusion, get all the investors, moving in the wrong direction, getting them convinced that we were going to drag down the entire world. And so we sold off all these emerging markets. We sold off the mature foreign markets. We bid up the dollar in anticipation that the world was not going to be able to survive a financial collapse in the United States. And I've always maintained that this financial collapse in the United States, despite the short-term problems of dealing with the losses, is absolutely the best thing that can happen to the global economy. Because moving forward, they don't have to support our economy. They can move forward without having to subsidize our massive consumption and our massive borrowing. And that's what you're seeing. Look at the news today with China and Brazil discussing ways of trading with one another without using the dollar, trying to invoice more global trade in the Chinese yuan or the Brazilian real. And again, more and more of our trading partners are looking to get out from under this dollar-based monetary system and reduce their theoretical dependence on having to artificially maintain the purchasing power of the dollar. And as more countries begin to realize that a dollar peg or the dollar reserve currency status is a detriment to their growth, that it forces them to subsidize our fiscal irresponsibility and our extravagance, that the best way to deal with our own economies is to cut the U.S. loose and to save and invest their own money in their own countries and to allow their own consumers to enjoy the fruits of their own labor. That's going to create an economic boom outside the United States. And I think what we're seeing in the dollar, what we're seeing in the commodities markets, what we're seeing in gold stocks, I think this is all showing that this is exactly what's about to happen. Anyway, stay tuned. And remember, I'm going to be talking again tomorrow on my radio show, Wall Street Unspun, which is on my website, www.europac.net, and on shortwave radio. Don't forget to tune in. We talk for an hour and we take calls. Anyway, that's it for today. Take care.